but you don't have you should not afraid to ask. That is the learning process. So I need your question. In this chapter is very critical. That is very crucial. So what I expect you is that I expect you to make sure that you pay attention. You need to pay attention. I want to thank Dr. Vamba for preparing this this work for the presentation of financial statements. That is very, very important. So I want to thank him for coming up with this. So what we need to do from our double entry system, we've got to prepare as an accountant. You're supposed to prepare the statement of profit and loss account. Then you're supposed to prepare the statement of financial position. Then you are supposed to prepare the statement of change in equity. You are supposed to prepare again the statement of cash flow. And again, as an accountant, you're supposed to provide notes which are related to the preparation of financial statements. So you need to know how to prepare these financial statements because they are very, very important. So this is covered by International Accounting Standards IAS1 that covers the presentation of financial statements. Because what we are here, our statement, they should be reliable. So the concept of reliability should be met, whereby we are saying our financial statement, they should be free from errors and bias. The financial statement, they should be present the true economic and accounting phenomena and events. And our statement, again, they should be relevant. When you're talking about the relevance of our statement, they are saying they should provide a proper feedback and a predictive value to the user of financial statements. So those are some of the accounting concepts which guide us, the accounting principles and fundamentals, the underlying the fundamentals which guide us when preparing the financial statements. So you don't have just to insert figures, but the reliability is very important. Reliability, we are saying, should be free from bias and free from errors, and it should describe the true economic event or an accounting event. Okay, we will just look on first of all, before we go further, just to browse, just to look on the that one, that's the template for financial statements. So what you need as an entity, you need to have revenues. When you're talking about the revenue, revenue, usually we are talking about what these are income generated in the what course of the business. So revenue is income generated in the ordinary course of the business. So that I want to call revenues. Revenues usually find out that if your business is of selling motor vehicle, your revenues are from selling motor vehicles. But for those assets which are going to sell, the assets for the business which are used to do day-to-day transaction, those they cease to be what is not classified as revenue. If you are doing the business of selling tomatoes, it means the lorry which you are using to get tomatoes are not. It's not. If you want to sell it, even if you dispose it, it's not a revenue. This becomes part of the gain. You want only the gain. Revenue, you want to earn the ordinary cost of what of the business. What you are doing, the main purpose of the business that contribute to what to our revenue. So we need to be very careful on this. If we dispose the motor vehicle, we only record the gains generated. That is the profit or loss realized by the business. So that's the revenues. So revenues consist of what? The sales, either credit sales or cash sales are included, because we are using the accrual concept. In the accrual concept, whether the cash has been paid promptly or has not been paid, the revenue should be what? Such income, such a transaction, they should be recorded as they are. So revenue here, it can be consist of what cash, and can have the cash and credit sales. Credit sales. These are part of the revenues. Then cost of sales here. Cost of sales, we are talking about the cost of goods sold, that is opening stock or open inventory. Then we add here purchases. Let me P for purchases. Then sometimes you can add the cost of bringing those items into use. That is maybe a carriage inwards. That is a carriage what inwards. It's included under the cost of sales. Then sometimes as an ended, this one, but these are the cost of what? Of sales. So you could open stock, add purchases, then add carriage inwards. Then sometimes then you less the closing stock. One, the cost of sales. We'll see it in detail. These are the very crucial, the two elements here, the revenue and the cost of sales. For the revenues, you generate them from the what? From the business. We've got cash sales and credit sales, all are included in the part of revenues. But disposal of assets, which are for the business, is not part of revenue. They come under extraordinary items. Then, so revenues minus cost of sales, it gives you the gross profit. This is what gives you a gross profit. That gives you what we call a gross profit. Then you go on, we have got other items such as operating expenses, we have got advertising, bank charges, carriage outwards, delivery expenses. You need to be very careful with carriage outwards. There is carriage inwards. Carriage inwards, it's included at the cost of sales because those are the costs incurred by the business in transporting the goods to its final destination. The carriage outwards, for example, Baker's Inn. When Baker's Inn is distributing bread, or locals distributing bread, it incurs what we call carriage outwards. There's what we call carriage what? Outwards. Those are costs are incurred, maybe the distribution costs, which are incurred by the business. These are operating expenses. They don't come here. The major pitfall by many students, usually the examiner will complain on this, that the many students, they include carriage outwards under gross profit. Carriage outwards is not part of gross profit, but is part of operating expenses. Then we go delivery expenses, wages and salaries for your workers. Workers need to be paid. You've got the rent, you need to pay rent. You've got electricity and water. These ones, they are subject to accrued rates and prepayments. What I'm saying this one, sometimes you can pay your rent in advance. Sometimes you can pay your rent in advance. That is prepayment. Sometimes you can fail to pay your rent in time. So that's why I'm saying this, they fall under what? Under the accrued what? Accrued concept. We need to be very well versed with this one. The big marks, you can get the big marks here when you are doing the adjustments. Repairs and maintenance, sometimes a given figure. You've got depreciation, you need to calculate depreciation. You've got set line method, you've got reducing balance. So as an accountant, you should be able to calculate the depreciation because when assets are being used, there is wear and tear. Those assets, their value is being reduced each and every time. So the entity should record for such losses, for such expenses, for such wear and tear, which is taking place every day. Okay. So That is the idea here. So let's look on the, so here this is the profit and what? Profit and loss. So profit and loss here, that is a critical element, but we need to adjust that. The big marks, will come here when you can able to adjust the accrual rates and the prepayment. Those are big marks. Calculation of depreciation, some of the big marks. Some of these given marks, sometimes they might have a very low mark. Sometimes half or a quarter, depending on the examiner's marking guide. But the marks are here on the what? On the adjustment. So you need to be very careful on this, because when you want to totalize, when you want to get an A, to be an exceptional student, when you want to get more marks, so you need to make sure that you understand the accrued rates and the prepayments and other related adjustments where necessary. Then this one, like what you're saying, sales, then returns. So how do you calculate our revenue? Like what you say, our revenue consists of the sales, then returns. Sometimes when we sell our goods to our customers, some customers, they will return those goods. Those are return inwards. Maybe you sold 20 television sets, that a customer may find out the other one is got a deforming, the other one is not producing clear pictures. Such returns, then the customer might return that good. It's no longer part of sales. This one reduces our sales. So we need to be very careful on that. Then you get the total revenue. That is a total revenue, or that is also what a turnover. Sometimes some books, they can give you the way turnover. Should understand that we are saying the turnover we get it from the revenue, then sales, then sales return. So our sales are reduced by returns. Then you go on the cost of sales. Cost of sales, like what I said we talk about the opening inventory. For example, usually the opening inventory for that particular year is the closing inventory for the previous year. For example, in year 2024, our opening inventory is the closing inventory for 2023. So we need to be very careful on this one. We need to be very careful on this one. Okay, there is a hand up, Mr. Gina Makosa.
Yes, sir. It's from the group. People are trying to join, and then they are saying that they're just being in the waiting room. But here on the screen, we can see them in the lobby. The lobby seems to be empty, so I'm not sure what's going on.
We can't see them here. I'm looking for them.
Yes,
can they
can't
join
see
the
them.
correct group?
They're saying so.
Hello?
Yes, they're saying that they've checked the credentials. They are correct, but they seem to just be being put on the waiting list. But here we can't see them in the lobby.
Yeah, we can't see them. I think
Yes,
can they go to the link which I gave them? They will be automatically appearing on the log.
Okay, sir. Let me tell them that. Thank you very much, sir.
They will be automatically. They should not create their own meeting.
Okay, sir.
Yeah.
Thank you, sir.
Because here on this case, we can't see them. I was looking for them, but I can't see them. And they need to attend. It's very important for you to attend these meetings, because at the end of the day, find out in the examination, people, they will be struggling to, especially in this topic of presentation of financial statement. This is always in the exam sometimes, because sometimes it's got 30% of the total. Then you find out many people, they are struggling. So that is very bad. So you need attention on this area. Okay, let's go on to the issue of let's go on. Here we are. We're saying the opening inventory, then the purchases which you did during that particular period. I was explained to say the opening inventory for 2024 is the closing inventory for 2023. You should know that. Then you've got the what? The purchases. And then you've got carriage inwards. The carriage inwards, they increase, like what I said, the carriage inwards, they increase the purchases. If you need to find the actual amount which you used to purchase goods, for example, from South Africa, you should say the cost of buying such goods plus the amount which you paid for transport, that's carriage inwards. You don't exclude it. That amount of carrying that good is supposed to be included. Then you've got the returns. The return is the return outwards because you are returned to the customer. For example, when you went to South Africa, you bought a television, then you find out one of the television is not working properly, you can return it. So when you return it, for you as a business entity, it reduces the cost of what? The cost of sales. So you should less it. This bracket, for those who are new, let me try to familiarize. When you put a bracket, it's a minus. We don't put a minus sign in account, except in our working. And then it means here, it's a minus. And again, here, it's a what? It's a minus. Good which you have purchased. For example, if you purchased 10 television and you find out that one television is with a problem, when you are returning it, that is a minus. It means you are now reducing this one. Goods available for sale, then the closing inventory. The closing inventory, we subtract it because the closing inventory, we did not use that good because we are using the accrual concept, whereby we want only the revenues generated in that particular period should match against the cost incurred during that particular period. That is the accrual concept, the matching concept. So in this regard, it means the closing inventory, we did not use that inventory was not sold. So that's why we reduce it. Then cost of sales here. These are very critical, very critical. You need to be familiarizing yourself with these notes. Then you can calculate the depreciation vehicle cost, that the cost, that is the amount, the amount which was used to purchase that asset, to bring the asset into use according to the standard of IAS 16. Then you've got accumulated depreciation. As I say, accumulated, it means over years. The asset is reduced, the value of the asset is falling each and every time. Then you've got the current charge. Then you've got net book what value. The current charge, that is for the particular year, because we want this figure. This figure under the current charge should be recorded in the profit and loss account from the income what statement. So we need to understand that this charge is very, well, that is the figure only which we had included in the profit and loss account. The depreciation charge for the current year, that's the only one which is supposed to be included. Then computer, motor vehicle, these are under PPE, property, plant and equipment. And that's why they are non-current assets. As compared to current assets are usually highly liquid. They can easily converted into cash. But these assets, current assets, they form our total assets. Non-current assets plus total assets. You've got the cash, bank, account receivable, possible adjustments. What we are saying, because generally, if you sell your goods for credit, between suppliers might find that one supplier might default, and if that one supplier default, it becomes a big problem. So if that supplier defaults, which means that It's a part of what? Of account of possible adjustment of debts. Might have bad debts or can adjust for provision for doubtful debts. Inventories, the figures of closing inventories that are very particular important. Closing inventory for that particular year, that's what we want to record here, that inventory. We don't want to record the inventory which was at the beginning, but at the end, or that the inventory which is at the end. Prepayment, this means we paid in what? In advance. If you pay ZESA, maybe your monthly bill for Zimbabwe Electricity Supply Authority is $20, then you pay $21. It means the 21 minus the 20, the $1 is a prepayment which forms the current assets. So you should understand that it forms the current what? Assets. Because why? Because the prepayment means you paid in advance. So say current assets. You paid what you were supposed to pay. Then you've got equity and liabilities. Our equity and liabilities consist of equity, that is the amount invested into the business by the entity, usually in terms of the capital. In terms of the capital, that is we invest our capital. In terms of this is a company, that is the ordinary share capital. It is an individual who invest the capital. Then the net profit. The net profit increases our equity. The net profit increases our equity into our capital. But the drawings which we can make, it decreases our capital. Drawings is whereby an individual can take money for the business to do to pay expenses which are not related to the business. For example, if visitors, they visited you, maybe special visitors, you can take maybe you are in a business of selling broilers. You can take maybe one broiler or two broilers to feed the visitors. If those broilers are for business, that is the drawing. Stock on its own the drawing. Or you want to please your friends by buying them beer. It's Christmas holiday. If you take money from the business, then you buy them beer with that money. It's a drawing, which reduces your capital. Drawings reduces your capital. You should be very careful in this one. Then you've got non-current liabilities. These are long-term loans. Those are long-term loans usually given by the bank. Then you've got the trade payables. The trade payables are usually creditors, because usually when we should understand one thing, that in many cases, then what we do in many cases, we find out that we cannot buy all our goods in cash to our suppliers. Sometimes we need to borrow, then we pay. Interest is accruing, should pay it maybe to the bank. Discuss the current liabilities. Current liabilities should be paid within that trading period. Then other accruals, for example, rent. If you fail to pay rent in time, then you pay rent, you pay a small amount or do not pay it all. The amount owed is some part of the accrual. Then you go total equity and what? Liabilities. Okay. Any question before we go further? Any question?
No, sir, you can continue.
But if you have got any more question, so This is very critical. To understand this, it becomes very, very important for you, because if you fail to understand at this stage, it means we might have some very, very, very big problems. Very, very, very massive problem for you. Having the challenge, which is that's what you're supposed to know at this level. Let me find out a question which we can do together, so that at least we find out if you understood this one. This one was just a theory, which was very important, but we need to do look on a very, very critical question, so that maybe the question can help us. So if you understand the question, it becomes very, very easy for us to be real accounted. So just hold on while I am supposed to remove this. I will remove this slide, then upload the other one. Okay, I'm now uploading this. So just be patient. I'm almost there.
Hello, sir.
Hello. Yeah, I'm still. Don't worry. I'm uploading the question. We need to do a question.
Okay.
So I'm thinking I'm almost there. So you need to be very careful when you are doing with these questions, because I'll concentrate mostly on the adjustments, because I know adjustments are a problem to most of us. Like what I said, this is where we have got big marks. So the big marks usually they are being given on people who can able to what can able to people who can able to make proper adjustments. So if you cannot make a proper adjustment, it becomes a very big problem. You cannot make proper adjustments. Okay, I've sent something there. Hello, colleagues.
Yes, sir.
We can hear you, sir.
Okay, I sent a question there which we want to discuss together, 28.8. What we want to do here, want to look more on the issue of adjustments.
It's not feasible, say.
Adjustments, those are very, very critical, because if we don't have adjustments, it might be very, very big disaster for us. Very, very difficult for us. For example, here, the following trial balance was executed from the books of R. Giggs at the close of business on 20th 2007. Purchases and sales. So these are purchases here, and these are sales. Cash at bank, 41,000 here. Cash, because these are assets on the trial balance. We get the assets on the debt side, then we get the sales liabilities on the credit side, but expenses and assets we get them on the debt side. So you need to be very careful on this one. Then capital account on 1,006, drawings 17,100. So as you read on, you should be able to understand, say cash at bank. Where do you place cash at bank? Cash at bank, we put cash at bank on the statement of financial position, SF. All right, SF here. Should understand where to place them. Some people they mix the major pitfall. Statement of financial position, SFE, cash at the end. Where do you place it? Cash at the end. Statement of financial position again. Capital.
I can't hear you clearly, sir.
Hello? Hello?
Yes,
Can you
hear
hear
me.
me?
Sir.
Hello, colleagues. You can't
Yes.
hear me.
No, sir, we can't hear you clearly.
Can hear you, sir.
Hello, sir.
Yeah, so for that person who does not hear me clearly, can he look for a better internet, or can he join your friends? You can share. It's not a test. You can share with your friends one gadget, one phone or one computer. You can share, even if you are 10 or 20. Okay, I was saying, cash at bank should understand that this one should be recorded on the statement of financial position. Cash at bank, cash at the end again on the statement of financial position. Then the capital here is at 1 March. You need to look dates. Dates are very critical. So what you need to understand is that dates are critical. Dates are very critical. So in this situation, find out that the date is on 28 February 2007. So you should look this one, capital account, as at 1 March 2006. This was the opening what balance. For this year ended at 28, so it started at 1 March. So this one is against statement of financial what position. This is under statement of financial what position. Then drawings, they should be adjusted to be adjust to the statement of financial position, because we say drawings, they less what? These drawings, they less our, at the end of the day, we understand that our drawings, they reduce our capital. Office furniture, this is statement of financial position subject to what? Depreciation, subject to depreciation charges. depreciation charges here. To understand that this one is subject to depreciation charges. I'm trying to paint it using the better color. Let me paint to here. Subject to depreciation charges. We don't pick as it is like this, but we should, unless it is at the net book value. If it is not at the net book value, we should adjust it. Subject to, because depreciation is an expense. Then rent is an expense. This one should be on the trading, that is trading profit loss account, or what we call income what statement. Rent here. Then here we've got salaries, wages and salaries. These are expenses to be included under TP, trading profit and what? And loss account. TPA here. Let me be informed. That is under income statement. Then here we've got discounts. Discounts, you should understand there's what discount allowed and discount received. To understand this, there is discount allowed, and discount what? Received. Discount received. Discount allowed and discount received. To understand these things, because sometimes you can buy to the what? To the supplier. The supplier, they can give you a discount. It's part of your income. Discount received, that one becomes a what? An income under other incomes. Discount allowed becomes an expense. This is an expense. I hope we are together here. This is an expense.
We are together.
We are together. Okay. They've got debtors and creditors. Debtors and creditors, they should be treated under statement of financial position. Statement of financial position. But debtors, as we said, it's subject to what? Debtors. Debtors is subject to adjustment, provision for doubtful debts. Stock at 1 March, we look at this. This was 28 February 2007. This is now 1 March 2006. So this one is, what kind of a stock is it? This one?
Opening stock.
Yeah, very good. It's now opening what? It's opening stock. That is opening stock, let's say OC here, to be treated on the statement. This one, it falls to 1. They are going to include it on their income statement. IAS income statement, the same as trading profit loss account. Then we are also going to include again in the what? Opening stock. That's all. Not a closing stock. Provision for doubtful debts as at 1 March 2006. Provisions. We want the increase or decrease. Decrease or increase. Will be what? On the increase or decrease. If the provisions increases, it's an expense. Let me write here an E. An E. Then if it decreases, if the inventory decreases, the provisions decreases, it becomes a what? An income. Becomes a what? An income. If those So you need to calculate them, becomes part of an income. Delivery van, it's an asset. An asset subject to depreciation. Subject to debt, that is for depreciation. Then you've got van running costs. These are just costs which are expenses. These are just expenses. These are expenses of the business. These are expenses. Year expenses. Bad debt written off. These are expenses of the business. Okay, that is very crucial here. So you need to understand which item goes where. So all these expenses, they should go into the what be treated in the statement of comprehensive income. Statement of comprehensive income statement. Then this one, assets, they should be only appearing in the statement of financial position, except depreciation. Only the depreciation should appear in the statement of comprehensive income. Stock 28 February. These notes are very important. This is where we've got big marks. The big marks comes here. This stock is an opening stock or a closing stock.
Closing stock.
Very good. That is a closing stock. Let's hold on. Okay, welcome back. Sorry. So sorry for the disturbing. Hello.
Yes,
Say-
yes. Welcome back. We can hear you, sir.
Okay, let's go on. Sorry for the disturbing. There was an emergency. Security items here. So here we're saying, so we need to understand like what is my friend saying. The stock at 28 February 2007. That is what we call, because if you look at the date, this was 28 February, so this one becomes a closing stock. So the closing stock, we should understand that this should be recorded in the what? In the statement of financial position under current assets. Then wages and salaries accrued at 28 February 2007, 340. How do you treat the accrual concept? These ones 1. These ones are big marks. 8, 2.
We'll add them to the current amount.
Wages and what? And salaries, and this.
Yes.
8 wages and let me say wages here and salaries. Then after that, then it's not all over.
The current liabilities in the statement of financial
Very
position.
good. They are current liabilities, and they form current what? CL for current liability. Then rent prepaid.
We deduct it from the amount that is given on the trial balance.
You reduce and
Yes.
reduce the what? The amount appearing in the trial balance and the amount appearing in the trial balance.
Then they are our current assets.
Wonderful. They are our what? CA and CA for current assets. Are we together? Yes. You might fail to find out what do I mean. CA for current what? Assets. Then these are big marks. So if you don't know this, you can get everything correct here. Then you come here and getting some marks here. Then you fall. You don't get big marks here. Van running cost owing. Ama owings. What are owings? How to treat owings? How do you treat owings? Owings.
Subtract
owings.
We add them
I
to
think
the value. We add them.
Yes.
To add, then add. So you increase, let's use the correct word. So increase expenses and this. Expenses in the income statement. In the, let's say, income statement. Then how do we do again? It's not all over. Treat them as what? Current liabilities, CL. So your owings now becomes this one for wages plus this one for running costs. It's a current liability on the current liability in the statement of financial position, SFP. How together?
Yes.
Yes,
Don't
sir.
want to see some people leaving them behind. It's very pathetic when you find somebody struggling. Somebody, the examiner always give a very negative report sometimes in these questions, whereby students they cannot adjust to make adjustment when necessary. Then increase in the provision of doubtful debts by £91. What does this mean? The increase, this is an expense, and this one there's in increase, it's an expense, and this all expenses they should be in the income what statement. Then provide depreciation as follows: office furniture 380, delivery van. All these are expenses. There is expenses and they reduce the value of the assets. The value of the assets. The value of the assets. They reduce the value of the assets. Okay. Any query? Any query?
Please, I didn't hear clearly on fund running cost owing. You can repeat the
In really,
fund
on what?
then running costs owings.
Okay, if you got owing, it means we did not pay, and maybe they somebody who did the job, we engage some expense which did not pay. So this one rises to current liabilities because they were not paid. Because here we've got these bank cost their expenses. So it's 615. So we say 615 plus 50, that is 615 here plus 72. You understand?
Yes.
Because they are owing. But the 72 should also go to the current what? Current liability as an expense.
Liability.
Altogether,
Yes.
as a current liability. Because it did not pay.
Yes.
So if it did not pay, it means you are owing. So in your books, this should be reported as a current liability. But here it's an expense on our what? We increase 615 plus 72. That is now you what? These are big marks. That is where you get big marks if you can able to what? You can able to make adjustments on that.
Okay, so since
Hello?
okay, so
breaking.
since it's an expense to us, can we put it in statement of financial statement of profit or
Financial
loss?
position, we only place 72 as a current liability.
Okay.
Because we did not what? We did not pay. We did not pay. So if you did not pay, then it means this one remains. Since we did not pay 72, it's a liability. But the liability should be what? Because using the accrual concept, the matching concept, whereby I am saying despite that we did not pay or we did not receive anything, expenses or incomes received during that particular period should be recorded, either cash or non-cash items. Though we did not pay, but we should take care of 72. Because 72 did not pay it, but it should be increased because it was not paid. That because it's not a cash flow statement. This is not a cash flow statement. Regardless, paid or not, 72 should be included in our expenses. And this 72 again should be treated as a current liability because it was not paid. Altogether.
Yes, sir. We can move on.
So that's the way we are supposed to do. Let me check I think we are left with some few minutes. Let me check with the answer 28.8 here. So that when you are at comfort of your home and then able to do page 322, then able to do some of these things at the comfort of your home. At the comfort of your home. When you get to home, then you just practice, makes perfect. If you don't want to practice, it becomes a very big problem.
Say.
Hello.
Yes, I want to ask something. On discounts allowed, we have discount allowed and discount received. So on the extract there is discount, then there is one in debit side and one in a credit side. So which one is the discount received and discount allowed?
Okay. What we are saying, and this the discounting received and the discount what allowed. And so yeah, coming up with a very good question, which usually confuses many people, and many people they fail to understand. Even the returns, they have been written like that. Let me go and re-explain this one. So I have to go back again here. Page 1. That's page 1, say 20 point something.
$28.8.
20.8. Those who are intelligent, those who capture. And here, the discount received is on this side. You understand? 160 is the discount allowed here. Okay, what we are saying, discount received is an income. All incomes are here. These are sales, it's an income. 160 is an income, what they are offered. So that because maybe you are paying in time or to encourage cash prompt, then the suppliers will give you that allowance. Then this one expenses, like what I said, all expenses and assets on the trail balance are on the debit side. Expenses, assets are on the debt what side. Then you've got liabilities, capital, and income. They are on the credit what side. Discount received, it's a what? It's an income. 160. That's why it is on the credit what side. Sometimes the examiner might not tell you that is the discount received or discount what allowed, but you should know that the one on the credit side is the what? An income, because all incomes are on the credit side and the expenses are on the debit side. If you've been answered.
Yes, but I want to ask about cash at bank here. It's on the side. So is it an expense to us?
Cash at bank, assets. I said the assets plus the expenses, they are on the what debit side. Well, these assets are being bought by either the money from the sales or from the capital or from the loan. Is when you are buying what you can buy, you can have cash. How do you get cash? Cash you both for double entry system. You get cash maybe after selling your product. These are sales you decide, or maybe after you go to the bank and get a loan, then you have got what? The assets. Are we together?
Yes, sir, we are now together.
So, because usually sometimes the examiner might give you some ledger account, or might say prepare a ledger account and prepare again the trial balance. So you should understand on the trial balance which items are supposed to be on the debit side and which items are supposed to be on the credit side. But what you should understand is that all incomes, that is revenues, and liabilities, and capital, they should be on the credit side, because these elements are the ones which contribute, which finance the purchasing of assets. The bank gave money, the purchases of furniture, the stock is being what is being purchased from this side, comes from the credit side. Have the idea. The expense which I need to pay here, you are paying them because you are getting money from either the sales which you received, or from the capital which you have, or from the other incomes. Are we together?
Yes, sir, we are together.
Any other queries?
You can go on. I'm
You can
okay
now
now.
go home.
Go on.
We want people to understand this, because these are critical. elements. So I wanted to understand where to get our, it was a good person to say the examiner just say discount. It's not specifically allowed or received, but you understand that these expenses are on the debit side and the income are on the credit side, which means that the discount he received, it should be on the credit what side. So these are some of those things which I encourage my friends to understand. So if you go, you've got about what, this is the other gigs, rain gigs, 28.18 here. So this is the solution here. Like what we were saying, just look at it to say I've given you the template. Comes is cost of goods sold here, opening stock, 8 purchases. That is from the symbol. Then closing stock here, gross profit again, discount received. You add discount received 160 here is added. Less expense is part of income. Wages and salaries, because of the accrual 340, that's why it was added, because there was an accrued amount. Here, rent, there was a prepayment of 230, that's why it was deducted, because there was a prepayment of 230. Discount allowed is an expense 820. Running, like my colleague was asking me to say 78, how do we deal with this one? This one, it increased because it was not paid, because it was not appearing on the trial balance. So 72 was incorporated then. Bad debts are part of the what expenses, as I already said. Then that's why they increased to 91. So you just pick 91 as it is.
So,
yes.
Sorry for interruption. I want to ask, why bad debts do we treat them as expenses?
Bad debts, they're an expense of the business. If we are writing off what they are saying, they have been written off, it means it's now an expense the business. The customers have not paid, so there's nothing we can do. They become part of expenses, becomes our betting, it becomes our babe. What people what they've been written off, so don't have the choice, becomes our betting. That's our babe. That's the problem. So we need to understand that they becomes our baby, our burden. It's an expense because we have written off what those bad debts. Are we together? Because here we are using what we call prudence concept. The prudence concept said that we should not overstate our assets and liabilities. So it's not overstate our asset, but overstate liabilities. So the prudence concept saying, if there are expenses, can you quickly take them as expenses so that you don't spend the funds which are not available? Because you're using the prudence what concept. Any other query?
We are answered.
Depreciation given simple 380,1250. That was very, very simple. Then the balance sheet. This one, it can be called statement of financial position, whichever the way, and whichever the way. Whichever the way. Fixed assets, these are non-current assets here. They can call non-current what? Assets. Office furniture here, minor depreciation, then you get the net figure. Delivery van, minor depreciation. Don't forget to take care of the depreciation. The depreciation here, which you charge here, should be reduce the value of your assets. Be very careful on this one. You need to be very, very careful on this one, because you take care of the depreciation element. If you write the figure there as 900 without adjustment, you get a 0. You don't have marks because they've done nothing. Current assets, stock is given. That's what we call, we need the closing stock. Then you've got debtors here. The debtors, we say they are subject to what? To adjustment. They have been adjusted by the provision for doubtful debt. when you are saying the profit for doubtful debt, then the doubtful debt should what? Should make sure that they reduce your debtors. For prudence concept, like what we are saying, we should not overstate our asset. A debtor is an asset, so by trying not to overstate it, we have provisions here. Prepaid expenses, like what I said, these are current what assets, because you paid in advance. Cash at bank, the same thing. Then cash at the end, the same thing. This one are not subject to what? In this one, they've got less marks, but you need to present them. Less current liabilities, creditors, it's okay. Expense owing, like what I said, you've got 340 here 340 plus 72 here. You go back to your trading profit loss account, there's 340 here and 72. 340 plus 72 becomes 412. Those are the expense owing. Those are accrued expenses. Then who finance this? This is capital, even figure. Our capital is increased by the profit for the year. So you pick this figure, which you get here. The figure which you get here, that is the 18237. That is the figure which you want to add here. So the figure here, which one it's is 13. The net profit for the year. After we've done this, this is the net profit for the year. Sorry, you go to the income statement, then you get the net profit for the year. Then this one, you should make sure that, so automatically it means if this figure is wrong, it means here it's wrong, here it's wrong. So you need to be very careful. But for the purpose of your own figure, and this, what you need to do, here is for you to make sure that you pick the figure which you got here. If you got $10, write $10 here, so that we know that you understand to say the concept, other than trying to copy your neighbor or somebody, because you are not sure about your figure. It can be rendered wrong. Even if it's 23937, where do you get it? We want the figure which you get here, that's the figure which you want here, to show that you know what you are doing, you know the concept. Because what is important is to know how to catch the fish. Are we together? Say this figure,
Yes.
and this figure, they are what? They are equal. Then let's drawings. Drawings, we say drawing the juice your what? Your capital, your equity. So the drawings, you pick them from the what? Statement of financial what? From the trial balance. Even the stock of drawings, if you take goods, maybe your favorite friend has visited you and you've got broilers for business, then you take one to slaughter and to feed your favorite visitor. That becomes even a stock, forms part of the drawings.
Say.
Yes.
I want to ask something here.
Yes.
For statement of profit or loss, there is a doubtful debt provision, which is 91. I want to ask, where did we get this one? I'm not understanding here.
Where do you want?
Where do we get this one, 91?
We're told. If you go to the question, okay, we'll go to the question later on after we've done this, since I don't have two screens here. The question was saying the doubtful debt provisions. There was an increase. If it's written, and this one was given, the increase, I said increase in provision for doubtful debt is an expense, but decrease in income. If there was a decrease, you are going to be what? An income.
Oh, okay, I hear you now.
For example, let's say at the opening balance for provision were 490. Then at the end of the year, they are now 600. You say 600 minus 590, 490. Then you say they increase by 110. So 110 becomes our increase in provision of doubtful debt. At first, you were setting 600, but during the year, they are now, let's say you were setting 490 at the beginning. Then at the end of the year, they are now 600. So it was an increase of 600 minus 490, which is what? 110. So 110 becomes an increase.
So say, do you mean so the increase, we are going to add it to the gross profit?
Their expenses.
I mean,
yes, let's say at the beginning, your provision for doubtful debts, they were 600. Then they are now 500. So it means there was a decrease of what?
100.
100. So the decrease of 100 becomes your income. So decrease in provision is the income.
Okay, I understand now.
So these are some of the big marks. Are we together?
Yes, you can go ahead.
Drawings, they reduce the what? The capital, that's why I said. So you need to be very careful on this one. Drawings, they reduce the what? The capital. So you need to be very careful on this one. Then you get this figure and this figure. In the exam, sometimes don't worry about the correct figures. The examiner sometimes will be get worried about marking the correct one. That's next. The examiner is what does not mark addition, but will mark the what? Do you understand the concept? So all these, what we're doing, these are usually guided by the two major fundamentals of account. Any question on this one? Any question?
We don't have questions, so we understand.
There are some people who are complaining. We are going to share with you the video, but not now, because it might take time for me to upload it. It's now too late. Some people are complaining, which is not we fail to get in the network, so on. But this one is helpful because we are recording this lecture. And this lecture, when you record it, you are going to access it. So there's a great advantage. So you can continuously, repeatedly, repeating it time after time. So those who are complaining on the inbox say, because if it is sometimes it is a face-to-face disadvantage, we don't record normally. But because of the technology, we need to abreast with the world, to be dynamic with the world of technology. Then I want to look on the any question. If there is no any question.
No, sir.
Hello?
Hello? I have a question on the layout of this account. At first, you were talking about putting figures in parentheses. Now, the arrangement has changed. I don't know which one can we take.
There is no rule. There's no rule which you can say you need to. You use the rule which you feel is good for you. Some they can do this directly in this one to say rent this one and this one. It's correct. Because if you lose the advantage of this, look, if you lose 3170, but you have showed this, you can get a mark. Or we can do the other one, which we did. I taught you 2 dimensions, and you can use the other one, the format one, whereby you go and say rent and it's paid, working 1, working 2. So you choose the one which you need more, which you are comfortable with. As an accountant, you should be abreast with the change environment. You should know all the from all the angles, so that you won't be argue, you won't waste time.
Okay, thank you. Answered. I think this one.
Because let's say somebody, maybe you are now teaching someone, then you teach somebody who has come up with this format and you don't understand it, or the other format which I presented at first, then you don't understand one of them. You seems like a person who have not learned enough, but you should know all the what? All the techniques. Are we together?
Yes, sir.
if you are together, then I hope people they will have time to read this at the comfort of their home. But before we go, I want to share with you something here, which is very important, which I saw many people having some problems. I'm going to remove this, then I'll share with what I want to share you as the last component, which is very critical. Okay, the last component, sometimes there is a very, very popular question. Are you seeing what I'm sharing with you about the fair presentation in compliance with the FRS?
It's not visible, sir.
It's not visible.
Yes.
You can't see anything.
Yeah, it's now better.
Yeah, it means your network might be a bit poor. There are two. Hello? We need to understand.
Hello?
When you are preparing our financial statement. Hello?
Yes, we can as well. It's what we are presenting.
Okay, we need to understand these two elements. There are two items, what we call faithful presentation. What do we mean by faithful presentation? Like what I was saying, it means when you are preparing our statement, we should not put numbers. Our financial statement should reflect the true position, should be free from bias, not just to cook numbers. So that is very important. So our statement should be reliable, so that the reliability is very important. So those information to present the faithful economic and accounting circumstances and phenomena. So those are very critical. These are very, very, very critical when you're preparing our statement. Don't cook figures. So a fair presentation is achieved by faithful presentation. So we don't want people who come up with their own figures. They don't describe the true phenomena or the true events of what is actually happening. That is wrong. We don't want such things. Then, so that is the fair presentations. I'm looking for the other one. This one, I talked about the accrual basis when I was teaching to say, regardless that you get a cash or not, we should talk about the transaction, whether cash is received or not paid. What we need to do is to make sure that we present our statement accordingly. As long as the transaction has taken place, it should be recorded in the trading profit loss account or statement of financial position. Accrual basis. When you are preparing a statement of profit loss account and statement of financial position, with the accrual basis. We don't use the cash prices only. So these are some of those things which I thought of sharing with you. Then I want to should not get worried much about this, but I thought you should understand that, and the information should be relevant. The relevant part of it, we are saying it should give us the predictive value, and the information which we present here, it should be the information which we can rely on for the feedback purposes. Feedback purposes to the financial users, people we use the statement, financial statement users, not to the information to find that the information is no longer relevant. That is wrong. So those are the key underlining qualitative characteristics we should understand. Those are the very key underlying qualitative of account. That is the faithful presentation liability and the relevance. So when you are preparing our statement, these are the two key. These are very important. That is relevance and reliability. Reliability, that is faithful presentation. Let me come here. Here, we have got relevance. So the relevance information provided by the measurement basis of an asset or liability of the related income. So we are saying the information which is relevant should have the predictive value and the feedback value. That is very, so if to make sure that you know these two keywords, predictive value and feedback value, we talk about the relevance. Those are very important to know those things. To say when the information to be relevant should be have a predictive value and feedback value, which means that when you are presenting it to the users of the financial statement, they should benefit from that. So that is very important. The relevance and reliability. Reliability, no bias, free from bias, but to describe the true and fair view of the business. Okay, any question?
We don't have questions. We are answered.
Any question? So these ones, if you need to, you should read on those things, because these are guided by accounting principles and concepts. So like what I are saying, say relevant information is one of both categories, predictive value and confirmatory value. That is the feedback value. So you should understand this. Then faithful presentation, that's what we are saying, should be neutrality, free from errors and bias, completeness. Those are the major pitfalls of many students in the exam. When they are being given a question to talk about material of faithful presentation and reliability or in the relevance, they won't write anything. So you need to understand this keyword, the key concept. So these are the key fundamentals of financial statements. So when you are preparing financial statements, you need to understand these critical elements. Any question?
We don't have questions, sir. Thank you.
Okay. So I want to thank you for making your extra efforts. This time, as we go on, find out the education is now critical because of technology. It can be done even online, everywhere. People, you can learn, you can do a degree while it's in USA and finish off. That is what we call technology. But if you still continue, you need to be work like long ago, whereby you should do. Even at the comfort of your home, you should learn. Even write an exam. That's what we call technology. You should move with time. It's unfortunate that some people, they don't want to move with time. It becomes very difficult. In this modern world, your generation, unless maybe myself, I'm now too old for technology, but I try to embrace it. So I hope you will benefit a lot. If you have any question, don't hesitate to post in the group. Only question concerning the account, not other questions which frustrates, but questions which about accounting, to say how do we treat such a transaction, or how do we treat a bad debt or accruals or any